Well, thank you for being here at Conversations with the Fed, an evening with Narayana Kocherlakota, President of the Federal Reserve Bank of Minneapolis. I'm Chris Farrell, Public Radio, Marketplace Money. Narayana Kocherlakota became head of the Minneapolis Fed in 2009. He serves on the Federal Open Market Committee, the monetary policy-making arm of the Federal Reserve System. He also oversees the operations of the Federal Reserve Bank, including bank supervision and regulation. He was born in Baltimore, Maryland, but spent most of his youth in Winnipeg. Good training for living here, since Winnipeg is really cold. He attended college at Princeton University and earned his PhD in economics from the University of Chicago. He has been a professor at the University of Minnesota and Stanford. He's published numerous academic papers, and he was named one of the top 100 global thinkers by Foreign Policy magazine in 2012. Now, all that's impressive. But what's really important is that I hear he likes to rock guitars Jack White. Good taste. He also did something I thought nearly impossible. He drove Paul Krugman, Nobel laureate, New York Times columnist, to humor. In a blog post, My Problem with Narayana Kocherlakota. Now, Krugman, he's got a lot of problem with economists. So I thought, here it goes. Here's what Krugman wrote. He has too many characters in his name. I mean, folks, the regular column has to fit into a limited physical space. And every time I mention the president of the Minneapolis Fed, there goes a large chunk of scarce journalistic real estate. Well, we have a lot more time. We have a lot more space. So we'll start off with some introductory remarks, and then we'll get to the highlight of the evening, questions.
Well, thanks a lot, Chris. Thanks for the introduction. And thanks especially to all of you for coming out tonight to this event. It's just great to see so much interest in the Federal Reserve. So as Chris mentioned, I'm going to open things up with some brief remarks about the Fed and my macroeconomic outlook for 2013 and 2014. But as Chris also said, really the main event tonight is taking your questions about the Federal Reserve and the economy. But first, a disclaimer. As you will hear shortly, I'm one of the 19 people who have the privilege and honor to participate in the meetings of what's called the Federal Open Market Committee, or the FOMC. FOMC meetings shape the course of monetary policy in the United States. But it's very important to understand that in my remarks today, I'm telling you my own views, and those perspectives are not necessarily those of any other FOMC participant. So let me begin with some background about the Fed. So relative to its counterparts around the United States Central Bank is decentralized. So the Federal Reserve is one of Minneapolis is one of 12 regional reserve banks. And along with the Board of Governors in Washington, D.C., make up the Federal Reserve System. Our district represents the 9th of the 12 Federal Reserve District. And our district includes Montana, as you can see depicted up there, Montana, North and South Dakota, Minnesota, northwestern Wisconsin, and the Upper Peninsula of Michigan. So as I mentioned, the Federal Open Market Committee, the FOMC, is the Fed's monetary policy-making body. It meets 8 times per year. So all 12 presidents of the various regional Federal Reserve banks travel from their home districts to Washington to contribute to monetary policy deliberations, along with the 7 governors of the Federal Reserve Board. So in this way, representatives from the different regions of the country have direct input into the setting of American monetary policy. Now, Congress requires the FOMC to make monetary policy so as to fulfill 2 mandates: to promote price stability and to promote maximum employment. Now, it should be clear that both of these are Main Street objectives. Promoting maximum employment means that the Fed is charged with doing what it can to ensure that Americans who want to work can do so. Promoting price stability means that the Federal Reserve is charged with keeping inflation close to a pre-specified target. Households and businesses engage in a large number of transactions, like mortgages or individual retirement accounts, that involve the exchange of dollars today for dollars in the future. Price stability ensures that they can have certainty about what those future dollars will be able to buy. Now, when I was talking about price stability just now, I made reference to a pre-specified target for inflation. And I didn't say what that pre-specified inflation target is. In choosing its inflation target, the FOMC weighed the costs of overly high inflation against the need to guard against potentially destructive negative inflation, so-called deflation. And this assessment has led the FOMC to pick an inflation target of 2%. And similarly, most central banks around the world have opted for a low but still positive inflation target. So, these are the two mandates, maximum employment and price stability. The FOMC acts to achieve those mandates by influencing interest rates through the purchase and sale of financial assets. When the FOMC raises interest rates, households and firms tend to spend less and save more. The fall in spending puts downward pressure on both employment and prices. Similarly, when the FOMC lowers interest rates, households and firms tend to spend more and save less. This puts upward pressure on employment and prices. However, these pressures on employment and prices from lower interest rates are not felt immediately. Instead, it typically takes a year or two for the effects of monetary policy adjustments to manifest themselves in inflation and unemployment. Hence, the FOMC's decisions about appropriate monetary policy necessarily hinge on what the members forecast about the evolution of prices and employment over the next year or two, what we typically call our medium-term outlooks for inflation and unemployment. So a key part of my job as a monetary policymaker is to formulate a medium-term outlook for the U.S. economy. So in the remainder of my remarks, I'll describe my two-year outlook for inflation, unemployment, and economic output. But I'll begin, though, by placing that outlook in the context of the evolution of these same variables over the past 5 years. So I'm going to start off by looking at the evolution of national output as measured by gross domestic product adjusted for inflation, so-called real GDP. As you can see in this chart, it goes back to 2007. As you can see in this chart, national output fell dramatically during 2008 and the first half of 2009. So that shaded area is what the National Bureau of Economic Research dated as being the recession starting in December of 2007 and ending in June of 2009. Right at the end of that shaded area, the recession, you start to see that output stopped falling and started to grow. So since the middle of 2009, the national economy has recovered at a moderate rate. So real GDP has been growing. However, if you look, we've got there a dotted line, the red dotted line. That maps out what real GDP would have done if it had kept growing from 2007 onwards at the historical average rate, around 2.5%. Well, it's still well below that historical trend, about 9% below that historical trend. Now, given that sluggish recovery in national output, the fact that we're still so far below that historical trend, it's not surprising that labor markets are also healing slowly. So the next chart shows what's going on with the unemployment rate. And the unemployment rate, which was 5% in December 2007, reached 10% in the second half of 2009. So it peaks after the shaded area. The shaded area ends in June of 2009. And then the unemployment rate peaks at 10% in the second half of 2009, around October. At the end of 2012, the national unemployment rate remains at 7.8%. So you can see it's coming down, but it still remains quite elevated relative to where it was in December of 2007. So the next chart shows what's going on with inflation. And it shows that inflation has also run below the Federal Reserve's 2% target. Now that's a little harder to see, but basically if you average over the past 5 years, the personal consumption expenditure, the PCE price index, has grown at an average annual rate of 1.7%. Now here I should emphasize that the PCE price index is an index that includes all goods and services, including food and energy. So I'm not talking about what sometimes is called core inflation, and this chart is not depicting what's called core inflation. It's what's sometimes called headline inflation, basically including all goods and services. So that's a brief review of the past 5 years. Real output remains well below what one would have expected it to be in light of historical growth patterns in the United States. Unemployment remains well above 2007 levels, and inflation is averaged below the Fed's target. Now, with that review as background, let me turn to my macroeconomic outlook for the next 2 years. This is all about what's happened in the past 5 years. Now we're going to build on that to look at what's going to happen the next 2 years. Now, to say something about that, I have to tell you something about what I expect policy to be doing, because monetary policy influences the path of these variables. So I have to tell you what my assumptions are about policy in order to provide an outlook of what's going to be happening to these same 3 variables. And in particular, what I'm going to assume is that the FOMC's monetary policy choices over the next few years are going to be consistent with the forward guidance about asset purchases and the Fed funds rate that are provided in its December statement. But that assumption about policy, my outlook for the next 2 years, can be summarized as being an ongoing modest recovery. So I'm going to go through the charts again very quickly, although this time I'm going to add my outlook for the next 2 years. So first of all, I see output as continuing to grow slowly, around 2.5% in 2013 and around 3% in 2014. Now, because that historical trend is 2.5%, growing at 2.5% in 2013 and 3% in 2014 makes very little progress at getting back to that 2.5% line. We'd have to grow faster than 2.5%, and significantly so, to start to make progress on that. Consistent with this slow output growth, I expect unemployment to continue to fall only slowly, down to around 7.5% in late 2013. You can see those numbers off to the right, and around 7% in late 2014. If you recall, we're at the end of 2012, we're at 7.8%. So we're continuing to fall, but still very slowly, given where we'd like to see unemployment be. I foresee this level of unemployment as continuing to constrain wage growth. Consequently, I see inflation pressures as remaining subdued. So you can see that right now, inflation is at below 2%, but I foresee that it's going to be rising only slowly back to 2%. It's going to be, my forecast will be 1.6% over the course of 2013 and 1.9% over the course of 2014. So that's my outlook for 2013 and 2014. And let me wrap up then with some conclusions. So as I mentioned that Congress has charged the Fed with making monetary policy to achieve 2 Main Street objectives: keep inflation close to 2% and unemployment low. Monetary policy tools operate with a lag of a year or 2. These lags mean that the FOMC's policy decisions are based on how it expects the economy to perform over the medium term. My own forecast, conditional on the FOMC's current monetary policy stance, is that inflation will run below the Fed's target of 2% over the next 2 years, and the unemployment rate will remain elevated. I think this forecast suggests that if anything, monetary policy is currently too tight and not too easy. So thanks a lot for listening, and I look forward to taking your questions.